Good afternoon, everyone. I'm Gary Hancock. I'm Managing Director here at DC, and it's a pleasure to be hosting this session. I've spent 20 years in the city and the last 15 with DC, mainly advising private equity shareholders and the management teams through transactions in the industrial products and services sector. And along with many of my colleagues in the different sectors across the private equity side of our business, we've seen recent increasing interest from core plus infrastructure investors in sectors from equipment rental through to telecoms and all sorts in between. So the agenda for this fireside chat, as Tim mentioned, is to explore that emergence of core plus infrastructure as an asset class and what it means for the owners and managers of private equity owned businesses that have the potential to meet the core plus criteria. So as Tim says, I'm delighted to be joined on stage by two genuine experts in core plus infrastructure and the private equity crossover. So first, Andrew Congleton to my left, a 25 plus year veteran of the infrastructure advisory world across Deutsche Bank, RBC, and a trusted colleague here at DC for more than 5 years now. And that period has seen huge growth in core plus infrastructure investment, and Andrew's been at the forefront of many core plus hybrid and first-time infra deals, as we call them. And Andrew and I are delighted to welcome our headline act, Andrew Dutton, who is the CEO of Ask4. Ask4 is a leading provider of managed Wi-Fi solutions for multi-dwelling units, including student accommodation and build-to-rent. And Andrew led Ask4 through the sale from Bowmark Private Equity to GI Partners, a leading US digital infrastructure firm. Prior to that, Andrew led private equity-backed Adair International through its sale to HH Global, which is a portfolio company of Blackstone. And as such, I think Andrew's pretty uniquely placed to provide insight into that transition from PE to core plus infrastructure, from sale process preparation, through deal execution, and through to the lived experience for leadership teams. I'm conscious there's a lot of managers of businesses in the room of those different forms of ownership. So thank you both for joining us today. Perhaps a bit of background and context. I've also got the joy of hosting a panel with two people called Andrew. So forgive me if I use surnames as well. Andrew Congleton, perhaps by way of background context, you could give us a little bit of commentary about what's driven this rise and continuing growth of both the number of and the amount of capital raised by core plus infra funds as an asset class.
Yeah, sure. Thanks, Gary. Wind back a bit, called it early 2000s, emergence of infrastructure as a real asset class in Europe. People were merrily investing in very core infrastructure, so regulated utilities, toll roads, airports, at 12% equity returns on quite boring business plans, very conservative. You then go through an extended period of interest rate compression, and the returns that really things were competed down to because of the amount of capital in the core market, you were looking at many assets trading at 7.5% equity returns. And frankly, the closed-end funds deliver a fixed-rate product to their investors, 8% after fees, 10% after fees, whatever their mandate is, whatever their promise is. So they need to look at riskier assets and evaluate those and put them in the infrastructure mandate in order to deliver those returns to investors. You then look at the core returns of 7.5% versus private equity returns, and there's a gap. And the infra GPs feel that they are the best people to assess the resilience of those assets and their infrastructure characteristics, and that just means the capital has flown into that and filled that gap that previously didn't really exist at a different time when there was less of a gap in returns between PE and the traditional infra.
And Andrew, we both use the phrase, the characteristics, the infra characteristics. Perhaps before we go to Andrew Dutton for the sort of practice, would you like to tell us a bit about the theory? What are the characteristics of a business that make it appeal to core plus investors?
Sure. So, you'll be well aware of the traditional thinking: asset heavy, capital intensive, very strong margins, and we can all look around us and see the things that feel like infrastructure. And at its most basic level, I think you should think of it as, is it an essential service to society? Are there strong barriers to entry? And then because we're talking about core plus, that maybe in your world doesn't feel like high returns, but for them feels pretty good, is it a platform for some growth? I think you can add to that, do I have inflation linkage? Is my downside protected? And I think last of all is is this a business that, under my period of ownership as a Core Plus investor, 7-ish years, say, that I can make more infrastructure-like by the time that I exit and sell again into another lower tier of cost of capital?
Very good. Thanks, Andrew. So, Andrew Dutton, you can tell us whether that is how you found things. So, could you tell us a little bit about Ask4 and what were the characteristics of your business that infrastructure funds particularly focused on relative to the private equity people?
Sure. So, as a business, we put critical infrastructure into multi-tenanted buildings, so student accommodation, built to rent, co-living, later living, and therefore those buildings in today's world cannot operate or exist either serving the residents in terms of receipt of managed Wi-Fi, which is what we put in, intelligent networks to hang IoT from, which is also what we do, and then also the IT management within those buildings. So from our perspective, when I guess we were looking at a Core Plus sense, we have asset intensity because we put a lot of hardware, active hardware into buildings, and therefore we ticked the box there. We have the potential to continue to put growth capital into everything that we do. Many of our clients buy, if you like, the hardware, but we loan it back to them in terms of recurring revenue. So that recurring revenue was another big tick in the box off the back of the assets that we're effectively putting in. The key mantra with us was about our ability to deploy even more capital. So how else were we going to deploy capital? We've done that. For example, we're investing 8 million over the next 2 years into dark fibre. So ostensibly by the end of their exit, we'll also own very substantial dark fibre across the UK and potentially into Europe. Inflationary linked in the sense of that we can effectively drive inflation over the length of the period. And the other key thing for them was unit economics. So high IRRs and ROIs in terms of the capital that we're deploying. So those were the key things that they found out of our business that effectively allowed them to invest.
Very good. And you talked a little bit there about the organic CapEx potential in your business. Did you find that infrastructure investors focused on different growth levers like CapEx as opposed to, say, a buy and build type acquisition-led strategy?
Yeah, I mean, differently from all of my experience with, I guess, PE, it was a very different set of conversations through the sale process. So it very much focused on the deployment of capital, how we were going to ostensibly put more cash to work. We'll come on to talk a little bit later about the kind of planning that we had to do. Yeah. But it's the first sale process I've ever been through where I didn't have to talk to my growth plan. I needed to talk to the cash deployment plan as part of that process. So very different in terms of the conversations that we were having through the process.
And just picking up on that point around sort of planning, what additional preparation did you have to do to be kind of infra ready for your sale process?
A lot. Get ready because it was tough, right? So the way that we effectively approached it is we worked with PwC to put a data cube together. So we went back 4 years and looked through multiple lenses. And when I tell you that those lenses were deep, they were. So we were looking basically at putting a data pack together that went by contract, length of contract, the margins in the contract, whether it was a CapEx deal, whether it was an OpEx deal, whether it had been renewed, if it had been renewed, what had happened to ARPUs, looking at ARPUs across the whole of the different sectors, by the different service lines that we delivered, by the countries in which we deliver them, because we deliver in over 12 countries. And ostensibly that, from our perspective, was about data and actually getting to that data. I don't think it took PwC that long to effectively put the data cube together, but a huge amount of pre-work because it was that ostensibly sold the business, because it was that gave the metrics that proved out the plan. The other aspect was we had to create a 10-year model in terms of where we expected the business to go over the next 10 years. If you can see 2 years out from the earlier conversations, if you can see 3 months out, you'd be lucky. But we had to build a 10-year model, effectively by service line, by country, by cost base, by country, with the cash flows that are effectively backing that through. Because again, that was how the business was evaluated. And ostensibly, if your historics didn't match to your forward plan, that's where due diligence can cause some real problems if those two things don't match.
And so how did that, so you've done all your prep, huge amount of work around data. There'll be people in this room who've heard Andrew Congleton and I talk about how important that is for being infra ready. So great to have one of our clients who's the lived experience to sort of back that up. But once you've done all that work and you're actually sort of off and running with the actual sale process, how did that process differ from, you talked about not as much focus on the forward plan. Were there other differences in the actual process from selling to infra versus selling to PE?
Yes, detail and data again is the way that I would describe it. So we probably did something like 20 odd fireside chats. What I see as a fireside chat was let's have a cup of coffee and I'll tell you what our business does. In the context of infra, it was a 2-hour meeting that was effectively going through an IM as a fireside chat. And then ostensibly when we built the IM was literally like War and Peace in terms of being able to describe the defensibility of the business. So most of the conversations that we had were genuinely about defensibility. So I remember going into the first meeting, we'd effectively presented out and literally left that meeting saying we're going to have to rewrite the script that we've got collectively on barriers to entry, because we probably spent 45 minutes to an hour of that meeting on defensibility and also on technically why we were differentiated and why others could not effectively replicate that technology. So very different set of conversations. And as I said, very little about what's the growth plan and how are you going to get there and why should we trust that you can. Essentially, the data that we'd done in the commercial due diligence was almost just taken as read. And therefore, if those are your historic metrics, the market's still available. Actually, our prediction is that you will grow at this rate.
Yeah, it's very interesting. And I can see it in things that Andrew and I have worked on where typically a Gary Hancock IM will have lots of charts that go up from bottom left to top right with arrows pointing upwards, and Andrew Congleton's IMs will often have lots of detail and nitty-gritty on the business and what its barriers to entry really are and what makes it defensible. So that's really resonates well. And was the overall timeline different? Did it take longer, less time? What drove the differences, if so?
I think, timeline-wise, it was probably 6 to 8 months in total. I think it was more the intensity of the pre-period and I guess the amount of time that the team had to spend on that. So you'd always expect that you're going to do some FDD and some CDD, and that takes some effort and some time. But ostensibly where the business really collectively had to get involved was the data collection, because we had missing gaps in terms of the data cube that we needed to produce. And therefore it was the intensity of that and the breadth of people that had to get involved to build that was far beyond that which I've been in before, where it might have been a smaller and tighter group of people just looking at some FDD and some CDD. So it took a much broader set of people to effectively genuinely get that data together.
Thank you. I mean, you're really giving us a sense of the sort of incremental work that's involved. So I suppose the question from the audience is, is it worth the effort? So Andrew Congleton, perhaps you could talk a little bit about the approach to valuation and how it differs between...
Ask the seller.
Yeah, I think it's probably fair to say we got quite a few turns more of EBITDA as a result of all this effort, and it is a lot of effort. I think the valuation approach is very fundamental cash flow based. It will haircut a growth plan without question, but it's really all about what cash flows can I underwrite with a high degree of confidence, how much leverage can I put on that, and just discounting the dividends that come out of it and the distributions over time, including the exit proceeds. The multiple that pops out, it's not irrelevant to a core plus infrastructure investor. They will look at it. But if they feel that the plan they've got is robust enough and the IRRs hit their targets, they'll kind of push it aside. And that, I think, is the fundamental difference. So we don't spend any time doing benchmark analysis and exit multiples as if they were gospel. It's all just about the cash flows and the return.
And you mentioned leverage there, Andrew. From your experience, Andrew Dutton was there. Did you find that core plus investors were taking a different approach to kind of debt structuring?
I think far more the conversation that we had and the debt structure that we put in place was really for, there was some acquisition pot that effectively put together, but growth capital was where we spent the majority of the time. and a necessity to effectively bring that through because there was an intent to deploy that and effectively get that working very quickly for return. So that was quite different in terms of the way that we focused in, particularly for that growth capital. Yeah.
Very good. And then kind of post-deal, the ownership
Yeah.
experience, particularly for the kind of managers in the room. What is it like being owned by an infrastructure fund? What does it mean for the management team?
It's good. I mean, I wouldn't say once you're over that line that it's very much different from working with PE generally. What I would say, a couple of bits of advice. In building the plan, don't put a plan together that knocks the lights out because they're going to discount it back so far. And ostensibly, you'll then get a good sense of package in terms of pulling together what a MIP might look like, and that will effectively, it's been really interesting looking at hurdle rates. So we get accelerators at 2 hurdle rates as a management team, but that's set at your plan level. And when I've now realised by how much they discounted the plan, I wish I hadn't put such a heady plan together because we might have got to those hurdle rates a little bit sooner. I think what is different is they are extremely data rational, and that's not to say that Beaumark, who are the previous owners, weren't at all, but the level of data that we effectively produce on a week in, week out, month in, month out basis, and looking at variations to that, even sometimes on a deal basis, is phenomenal in terms of the way that the investor is thinking about it over the long term. And I guess the big difference, particularly for myself and the CFO, who've come from a PE world, and we both came from a long time ago, large PLC world, is just the constant move to try and deploy capital and use capital and effectively spend it. And ostensibly spending it either for growth or ostensibly to try and get our operating costs down. They're far more concerned with our long-term run rate and our exiting run rate than they are with the in-year EBITDA. So we're used to wanting and needing to hit an in-year number to effectively show continued growth. And whilst that's going to be important for exit, they're far more concerned with where do we end up on a run rate basis by the time we exit, rather than the journey necessarily that we've gone on.
So do you find then there's a difference in a kind of time horizon perspective in where they focus?
Completely different. So GI Partners, who we're held with, they expect to go 5 to 6 years. Yet when we are looking at capital investment into the business because of its longevity and contract nature, they're quite happy to see an investment thesis that effectively says, well, that's 10 to 15 years. So, for example, we're investing in dark fibre. That dark fibre will effectively stay within our business to 15 to 20 years. Now, it's got reasonably good payback and within a payback period within the ownership of GI, but its long-term benefit for the next owner is where they're looking, because what that's going to do over the long term for the next owner is reduce effectively the gross, or improve the gross profit over time, because ostensibly one of our major cost bases has dropped significantly. And when I say that, our investment will drop, I guess, a gig line or a 10 gig line from something like £4,500 to £5,000 a year to £400 a year. So it's massively different, but very much focused on a longer term view.
Great. And then maybe sort of picking up that theme around exit strategy. I mean, if we're doing buy-side work for private equity investors, writing an exit paper, we're often thinking about, who are the strategic buyers? What do we need to do to make this business more attractive to a certain trade buyer in a different territory? We might be thinking about what the private equity buyer landscape looks like, albeit it's not an unusual question from our clients to say, who am I going to sell this to? And don't say private equity. I really want to know how I make this asset really strategic. I know, Andrew Congleton, you touched on it in your intro. How does that differ from how core plus investors are typically thinking about their exit strategy?
I mean, I think all the same exit considerations do come in, but I think typically your core plus investor is looking to evolve the business they buy to a scale and to a risk profile that suits a lower cost of capital again, and a new pool of people who maybe wouldn't look at a smaller business that was still growing, but absolutely when it's evolved will be straight there at a lower cost of capital and therefore a higher valuation. At the end of the day, as much hard cash as possible with closing certainty is the is the objective. Anything else, mergers, IPOs, breakups are very much second best.
And Andrew Dutton, from your experience, did you see investors placing a lot of emphasis on thinking about exit strategy as they were sort of embarking on the investment from the start, or even shortly thereafter?
I mean, less conversation on the way in, but certainly literally within 4 weeks we were in a room working through what our exit strategy was, and really thinking about, and again, I'm repeating myself a little here, but going back to particularly revenue visibility, how we were going to get that over the long term, how we could stretch out contracts in terms of assets that we were deploying, genuinely looking at asset density in terms of what more could we do to effectively become and look more infrastructure-like. So as a business, for example, we put active hardware into a building. What they were effectively saying to us, well, why can't we get the passive into that? So for anybody who doesn't understand that, it's effectively putting cabling. For us, cabling just feels like low-level hard work as a business, and it's something that we've actively said we don't want to do. Whereas we've now got an investor going, no, if we can get a Wayleave over 25 years and we're getting a revenue on the back of that in terms of putting that passive infrastructure in buildings, then we'd really like you to go and look at that. So we've had to think quite differently as a management team. So things we will have avoided in the past because it was relatively low margin, ostensibly we're now looking at going, okay, well, how do we change strategy that allows us to think more about being, I guess, more and more infrastructure-like by the time that we exit, particularly generating long-term repeatable revenues off the back of hardware that we're deploying.
Very good. And we're going to go to the floor in a moment, but maybe just one last thought to finish on, Andrew Dutton. If there was kind of one word or piece of advice you would give to the owners or managers here who want to make their, aspire to sell their business to a Core Plus investor next time round, other than obviously hiring DC, what would your piece of advice be?
It would be take the characteristics, map your business to it, and start collecting the data now. Do it now. Don't wait. Because it will help you understand whether by the time you get to have a conversation with DC that you've got a series of characteristics that would enable you to be into that Core Plus world. That was a big gap for us in the sense of we decided to go do that as part of the process that we set off with DC. It would have been much better had we done that. When I talk about the data that we now work with GI, we are literally monitoring and measuring that data, as I said, on a weekly and monthly basis, because they know we're going to have to replicate it on the way out. So do it now.
Very good. Do we have time for any questions?
Nice to see you, Andrew, and thank you, Gary. So I'm Sam Smith from Pep Talks. Couple of questions really on behalf of our members who might be looking at this as an exit strategy. Just, are there any commercial differences in how a Core Plus investor operates versus a traditional private equity, just in terms of life cycle of the funds, hold periods, and then the second stage of the question is, are the MIPs more or less the same? Do they incentivise in the same way?
Who wants to take that?
I'll start with MIP. MIP is strong. I would say the debate was quite late in the day, so it wasn't their first thought, but it was definitely not their last thought. Hurdles are reasonable in the sense that the cost of capital is lower, and therefore what we've seen is that as a management team, if we can hit, there's a first hurdle and a second hurdle. If we hit those second or those first and second hurdles, which we are currently on track to do, then it is far more lucrative than PE for a management team in terms of the return that we're seeing. I don't know if you want to take the first. So, what was the first question, Sam? So the first part of that question?
That was my second.
Sorry.
The first part was, are there any differences in the commercial structures of Core Plus funds in terms of life cycles, fees, and then hold periods?
So do they hold assets for longer, Andrew?
Yeah, I mean, they'll hold assets for longer. I'd say, let's call it 7 rather than 3 to 5. Might be shorter, might be longer. And I mean, interestingly, with some of the longer holds, to come back to the midpoint, you actually find that there'll be liquidity along the way, which is often a fear, I think, of management teams coming in. Do I really have to wait 9 years? And the answer is no, you don't.
Yeah, what I would say is that with GI, who were far more P-like in the way that they put the MIP together, there were others that we were talking to where ostensibly there were liquidity events along the way. So actually, interestingly, before a 5-year time horizon, but then beyond a 5-year time horizon. So there were definitely liquidity events that were optional, if you like, in terms of the way that you could either take that liquidity or reinvest that into the future.
Very good. Thank you very much. Andrew, thank you for joining us this afternoon. I'm sure there'll be a chance to ask questions as well later. Thank you. Cheers.